Okay, perfect. Let's begin then. So once again, hi everyone. It's very nice to meet you. Welcome to Agendi's Materiality for CSRD webinar, during which we'll talk about the Corporate Sustainability Reporting Directive, the new regulation from the EU, also known as CSRD, and best practices in addressing its double materiality assessment component. My name is Mikołaj Spunar. I'm a senior associate consultant in the London office of Agendi, joined here today by two of my fabulous colleagues, Victoria Teslav and Kevin Fertig. I'll hand over to them for a brief round of introductions, and then we'll jump into the webinar.
Hello, everyone. Welcome to the webinar. My name is Victoria. I'm a manager based at the London office in Agendi and mainly work on regulatory disclosure, including double materiality assessments for CSRD.
It seems that Kevin is still stuck in another call. He will be joining in a minute, but let us proceed with the presentation of Agendi. So before we move to CSRD, we would also like to give you a bit of context about our company itself. We're a specialized sustainability firm providing consultancy services to large organizations. We support our clients through knowledge and capacity building, help them understand their impact, support the strategic planning, enable action, as well as assist them in reporting and different types of disclosures, including CSRD. This broad scope of work includes GHG calculations, ESG materiality assessments, defining net zero strategies and plans on achieving long-term commitments. We also practice what we preach, hence Agendi is a B Corp certified firm and an accredited partner of CDP with science-based targets in place. When we move on to the content of today's call, we will focus on CSRD aligned double materiality assessment, also known as DMA, an acronym that will very often shine through during this webinar. We'll start by explaining the content of such assessment. We'll provide different options of approaching it, explain specific steps that need to be taken to ensure it is aligned with the European regulations and different types of standards in place, known as the European Sustainability Reporting Standards. We will also cover the topics of auditor requirements and assurance. And at the end of the webinar, as mentioned before, we aim to answer any questions that you might have following the contents of this webinar. So starting off with the introduction about the CSRD. CSRD is the most extensive and far-reaching sustainability reporting regulation. What gives it even greater importance is that both EU and non-EU companies should be concerned about it. The regulation is already in force, with first reports due for publication in 2025 and different tranches of companies coming in at later stages. It applies to a wider range of companies than its predecessor, which is the Non-Financial Reporting Directive that some of you may know as NFRD, including non-EU companies which have European presence or generate revenue in the European Union. The expanded scope includes over 50,000 entities located all around the globe, and the thresholds for disclosure include revenue generated in the EU, net assets, number of employees, and listings on EU stock exchanges. The most important regulatory change coming out of CSRD is the requirement of conducting a so-called DMA, which is a double materiality assessment, considering both businesses' financial and impact materiality. Reporting must be then assured by an independent auditor and published for stakeholder access and analysis in digital form. Moving on to the specific disclosures that actually come into CSRD. It is really worth taking a note that a significant majority of disclosures under CSRD is based in the findings of the DMA process. According to EFRAG, which I will explain in a minute, 79% of sector-agnostic standards are actually subject to materiality findings across the ESG, which is the environment, social, and governance areas. While high impact sectors such as mining or oil and gas, which you can see in the right bottom corner, are subjected to greater scrutiny, the DMA process requires that all specific topics outlined in the standards published by EFRAG are properly addressed. So this is worth keeping in mind. This process will consolidate many disclosure points that you might face in the future. Moving on to what the materiality assessment actually is, let's start with the definition. So materiality assessment is a structured process of engaging with internal and external stakeholders, which helps you to identify and prioritize ESG matters that are most material. Such assessments can serve as a strategic guide for your organization, help you identify ESG issues that you will be facing and that you should focus on in your sustainability strategies, be used for voluntary reporting or attaining ESG ratings such as the S&P or ISS ESG. And most importantly, they will be a part of your disclosures within CSRD and can support other mandatory reporting within ISSB and TCFD. When it comes to specific things that it can help you with, it can help you develop your sustainability strategy. It helps you identify the ESG issues, tells you what to focus on. It can help you set your ESG goals and targets, since it sets ambitious targets and goals, which are actually part of the assessment. Then it can help you develop your ESG performance indicators and essentially pinpoint where they should be located. Finally, it helps you report on your ESG performance, not only within the regulatory aspect, but also within your ESG reports. Moving on to the main differences between the typical approach known as singular perspective and the CSRD materiality. Most of you might actually be acquainted with previous ways of running materiality assessments. Those are the so-called single materialities. When we compare the traditional approach against the one required within the CSRD, we can see 6 major differences. Firstly, while traditional approach was more focused on singular perspective, aka the financial materiality, CSRD requires a double perspective, including impact materiality. Secondly, single materiality assessments were based on SASB Materiality Finder and GRI guidance, while CSRD falls under European Financial Reporting Advisory Group standards, the group, of course, being EFRAG, and you can see this amazing acronym on the right. A direct result of that is the type of output that you get from such an assessment. Traditional materiality assessments prioritize sustainability matters, while ESRS requires disclosing all of the associated impacts, risks, and opportunities which are deemed material to your operations. Importantly, all of those IROs have to be identified within the company's value chain as well, which goes beyond the old disclosure of direct operations and strategy. On top of that, any material IRO sitting within a subsidiary, value chain, key business area, essentially every single part of your value chain are rolled up into the result, while traditional approach focused on only consolidated group level disclosure. Finally, while traditional approach encompass short-term with inconsistent applications of dynamic materiality, CSRD requires medium-term and long-term to be considered within the assessment. Moving on to the main differences that come out of that in practice. While singular materiality considered the financial materiality perspective of incoming risks and opportunities on the business, double materiality introduces impact materiality perspective related to outward impacts of businesses on people, society, and also the environment. Different issues within the assessment are grouped into sustainability matters, which essentially serve as umbrella categories for the so-called IROs, which are the aforementioned impacts, risks, and opportunities. Risks and opportunities refer purely to the financial materiality perspective, and for impacts, you have to think about the way your business impacts the outward world. A good example to picture how IROs work in practice is the example of sustainability matter that you can see on the left, which is the GHG emissions and energy. Within such sustainability matter, we can single out a risk of reputational damage from failing to meet climate targets, which might have a negative financial impact on your business. On the other hand, when you look at the opportunities, you can actually reach a lower energy consumption, which might lead to a decrease in your operational cost, which in turn will result in positive financial impact on your business. Last but not least, companies' emissions negatively impact people, society, and the environment through direct contribution to climate change. Similar examples could be provided for other sustainability matters, with scope ranging from diversity, equity, and inclusion to information security and data privacy. and all of their associated impacts, risks, and opportunities, IROs, which then have to be disclosed within the regulation. Moving on to what the output looks like in practice. Once the DMA process is conducted and sustainability matters are assigned a score, this is the type of matrix you end up with. The left axis represents the impact materiality, so your business's outward impact on environment and society, and the bottom axis represents financial materiality, which would be inward financial impact of risks and opportunities on your business. Importantly, unlike single materiality assessment, DMA also considers sustainability matters coming up as material in terms of impact. So previously, you would be looking into the financial materiality aspect, which is the inward impact on your business, the different type of profit, and the ways it can be affected. While for now, the impact materiality and how you affect people, society, environment also plays a huge role. Hence, even if given sustainability matter does not score particularly high in terms of financial materiality, impact materiality itself might make it material to your business and make it onto a required part of your disclosure under CSRD. Coming to the disclosure, of course, once strategic material matters and correlated IROs are identified, those are to be reported under CSRD with dedicated auditor sign-off. When it comes to different types of standards used in running a DMA process, in May 2024, EFRAG published a set of guidelines, which includes the materiality assessment implementation guidance, essentially setting the groundwork for the entire process. It includes the value chain implementation guidance, which complements the original guidance and shows more or less how you should address the value chain issues, how you should interact with your different types of stakeholders within your value chain, and so on. And ultimately, it published a list of ESRS data points, which help you pinpoint the different disclosure requirements and different topics that you should consider in your assessment. While the standards are non-authoritative, they still leave some flexibility in terms of interpretation. And on top of that, EFRAG provides feedback statements based on consultation process, which you can also refer to in case you have any further questions. As Agendi, we together will focus throughout today's webinar on the implementation guidance and on the value chain guidance. But when it comes to the list of data points, we actually have developed a gap analysis tool to map companies' preparedness against these ESRS data points, as well as other prominent sustainability regulations which are already in place. At this point, I will hand it over to my colleague, Victoria, who will run you through the typical methodology in running a DMA process.
Perfect. Thank you, Miko. Before I continue, just as a quick note for everyone, we have the Q&A function activated. So if you have any questions, please put them in the Q&A box. We are happy to answer them later. We saved around 15 to 10 minutes in the end for the answers. What I'm going to walk you through now are the 8 key steps to an EFRAG-aligned double materiality assessment. Those are mainly based on the guidances that Miko just presented, and then on our experience conducting EFRAG-aligned double materiality assessments with our clients. So you see the 8 steps outlined here, starting with the context setting and value chain mapping. Second, the sustainability matters shortlist. Third, value chain analysis. The IRO inventory as a draft here, because they will be finalized after the stakeholder engagement. Thresholds and time horizon setting. Stakeholder engagement in the finalization of the IRO inventory. Scoring and results, and then the documentation and sign-off in the end. Of course, we mentioned here also the auditor methodology sign-off in between, because we see it as crucial to collaborate with auditors early on, especially at this point that we mark between 5 and 6, so before you start the stakeholder engagement and subsequently the scoring and results, to ensure that the auditors will sign off at the end, because I think, as Miko mentioned before, the double materiality assessment needs to be audited. Then one last note on the steps in general is that they're not necessarily sequential. You see the little double arrow between 2 and 3, so sometimes you have to go back and forth, which I will explain in a bit more detail. But coming now to step number 1, context setting and value chain mapping. So how we typically start with is, of course, to understand and review the CSRD compliance deadlines for our clients. Companies understand what entities fall under CSRD, understand, of course, and have an overview of the complete business activities in the relationship between key affected stakeholders. So we would look at the business segments, of course, then also at the regional services and geographical variations. That's one part that is very clear in the guidelines, that those have to be taken into account when analyzing, of course, different IROs for different countries. There might be differences, especially if you have different or slightly different business models depending on the countries. Then as a next steps in this context setting, still number 1 here is the identification of affected stakeholder groups and the identification of users of sustainability matters, of sustainability statements. So we map the complete value chain upstream and downstream according to the value chain guidelines that have been mentioned by Miko before. But not only suppliers and customers, you also look at other value chain members and wider stakeholders. So for example, investors, regulators, has wider stakeholders that are specific to your own business. So for example, also regulators, maybe tax authorities, assurance providers, and so on. As the next step, we also would look, of course, at any potentially previously conducted materiality assessments, even if it's most likely a traditional single materiality, it's still useful to take into account the previously identified material matters. And then would supplement for the context setting everything with potential business statements, public reports, doing a media and reputation research relevant for your industry, identification of relevant peers, of course, and leaders to do a benchmarking and understand the materiality implementation results. One mentioning here as well is that the guidelines say you have to consider nature as a silent stakeholder. Of course, nature can't speak for itself, but it needs to be considered. So that's complemented with desktop research. A lot of context for number 1 now, but I'm moving now to number 2, sustainability matters shortlist. So how we typically start is that we start with building a comprehensive long list. So one starting point, ESRS defined materiality topics. And in an appendix, you can see when you look at them, it's a big focus mainly on social topics, more limited focus on environmental and governance topics. So it's not an all-encompassing list. It's a starting point, but not the only point. That's why it needs to be complemented with other entity-specific additional topics. So as I mentioned, the previous materiality assessment, peers assessment, industry and sector analysis, further literature review, other frameworks, and then also potentially published articles relating to you as a company or to your wider sector as a company. So this is taken into account to develop a long list of sustainability matters. What we as Agendi do then, we utilize a quantitative scoring approach to then evaluate the relevancy of all those long listed matters to develop a short list of potentially material sustainability matters. So those, just to give you an indication what numbers we are talking about, so it could be 15 to 25 is normally a range that we see within companies for sustainability matters in the shortlist. That doesn't mean that all of them are material. That means that is your starting point to do the assessment. Of course, this list of around 20 topics gives you an opportunity to early assess your data and reporting maturity, which is beneficial when you look, of course, into your CSRD reporting and want to get an early indication what topics you might need to report on. As Miko mentioned before, 79% of the disclosure points within ESRS are based on the outcomes of the materiality assessment. And of course, if you do not collect the necessary data yet or don't have the policy in place, this early start gives you an opportunity to utilize the time while you're conducting the double materiality assessment still to have an idea on the data points you need to report on. That was number 2, so developing the sustainability matters shortlist. Step number 3 is the value chain analysis. We did this double arrow here because, of course, the value chain analysis results can potentially influence your sustainability matters shortlist. So what we do for the value chain analysis is, of course, we start off of the value chain mapping from step number 1 to have a starting point and understand your relevant value chain, your relevant stakeholders within the value chain. What we do then is we do a detailed review of key customers, key suppliers, and strategic partners. So if you have close relationships with specific companies, also with key investors, we go into as much detail that we look into published materiality assessment from those partners. Of course, that is not feasible and not necessary for your complete value chain, but for the key partners. How we then normally break down the value chain analysis for the wider value chain is that we compile them into sectors to understand your key supplier sectors, for example, or key customer sectors, to do the assessment based on that. And as I said earlier, that might, if a specific sector has specific issues that might influence your company, then it might trigger a new sustainability matter on the shortlist. Doing a very quick pause here before I move on to number 4. Number 4 is the IRO inventory, the draft, as mentioned before. So we develop typically also a long list of IROs, meaning a large inventory. It can range, or what we saw, I think so far for our clients, is a big range between maybe 100, 150 to around 250 different IROs. Depends, of course, how much they're split out within the company. But to have them as a long list, it does not mean that they're all material. It does not mean that they all relate to material matters. However, we see it as a good starting point to have a complete long list of IROs. Those are impacts, risks, and opportunities, just as a reminder for everyone. So what we, or how we develop the IRO inventory, mainly we have 2 different group of sources. One source would be the clients or the company's internal documents. So for example, internal risk management frameworks. Some companies might have specific sustainability risk management frameworks, wider internal documents as well. And then, of course, publicly facing documents, annual reports, where you mentioned with TCFD reports, including climate-related risk, and so on. And of course, we supplement that with further research, media and reputational research included. After that, we come to the threshold and time horizon setting. For the time horizons, the EFRAG guidelines, the Materiality Assessment Implementation Guidelines, give an indication. So you need to have a short term, a medium term, and a long term for your assessment. The time frame they give as a suggestion. You can adjust, but you have to reason why you adjust as a company. The short-term time frame would be 12 months, basically 1 year. The second one, the medium term, would be 1 to 5 years, and the long term 5+ years. You can deviate, however, as I said, you have to reason it. And what we have seen previously is that also when the auditors look at the methodology, they also want to understand the reasons behind deviating in any points from the guidelines. When it comes to thresholds and scoring in general, the guidelines give guidance on scoring, of course, but there is a bit of flexibility as well. When we look at impact, we would typically look at 4 different dimensions. So the dimensions are magnitude, spread, degree of recovery, and likelihood for the impact. And then we have, of course, the financial materiality on the other side, where we also understand with our clients together what type of quantitative analysis is feasible, is possible. Some clients have already at least a climate-related financial analysis conducted, what climate-related risk mean for them. But of course, for ESG double materiality assessments, that's only one part or one small part of the assessment. And after you set all the thresholds in the time horizon, we think this is a crucial point to engage with the auditors to come up with a stakeholder engagement strategy, sign that off with the auditors as well, and then start the stakeholder engagement, basically. So for number 6, stakeholder engagement, we of course understood now earlier on in the process the involved stakeholders. We have here, of course, internal and external stakeholders that we want to and typically consider when conducting a double materiality assessment. So when we think about internal stakeholders, of course, we have wider employee groups. We always want to make sure, of course, that when conducting a double materiality assessment, for example, on group level, that we have a coverage between different entities in the different EU countries, so that employees from different regions or also from different business segments are incorporated into the stakeholder engagement. And of course, some form of leadership, depending on your company, how it's structured. Board of directors could be included, executive leadership, or different members of the C-suite. Potentially, you have a specific working group for the double materiality assessment, so that can be evaluated. And then when we look at external stakeholders, we look at, of course, key suppliers and customers, investors and other shareholders, potentially at specific industry groups, strategic partners, if you have some, and so on. So there are a group of different external stakeholders. Then we prioritize those stakeholder groups, understand where it's most appropriate to conduct a survey or to conduct interviews, because as an outcome, of course, we want to have some level of quantitative outcomes so that we have like clear scoring of the IROs and sustainability matters associated with them, so that we have clear outcome also. And Kevin will talk later to that, to have a good foundation in year one. So this is a very comprehensive process to make it easier and more streamlined for companies to conduct a refreshed double materiality assessment or light touch refreshment potentially in year two. So we see it as crucial to collect quantitative data in year one to make it easier for the future, basically. That's why we want to have the quantitative input. However, qualitative input is also very important, very useful to understand the applicable IROs and relevant IROs for companies. For example, speaking to subject matter experts for specific sustainability matters, or for specific IROs in different teams is gives very useful input to understand which IROs in the end will be material, because that's, of course, the outcome we, our client and other companies want to understand. That was number 6. Of course, the idea is then, as a result of the stakeholder engagement, which will encompass the scoring and results, to be able to finalize the IRO inventory and rank the IROs that are material for the company. When it comes to scoring, number 7, of course, it's a double materiality assessment, so we score on impact materiality and on financial materiality. On the left-hand side, you see the different dimensions I mentioned, so scale, scope, degree of recovery or remediability. And one important note here, of course, I mentioned the different timeframes before, so the short, medium, and long-term timeframe. So it's crucial here to do or conduct this scoring on each of the timeframes, so that you can end up with a matrix like this that you can see here below illustrated. So with 3 versions of this one for the short, medium, and long term. As a quick note, it's not required to publish a matrix like this. We see it typically for traditional materiality assessment, and we still see it also for double materiality assessments. However, it's not required to necessarily publish a matrix like this. And then when you look at the right-hand side, you see assessment for financial materiality. Of course, the thresholds were set earlier. It makes sense to align those thresholds with your risk management framework, to align with your typical financial threshold or significant financial thresholds that you have in your company. And of course, those will also be conducted over each time horizon. And just checking if I forgot anything. No. So it will be scored like this, of course, and will be combined, or you can combine it to one matrix, looking at impact materiality on one axis, financial materiality on the other one. And then you can see the matrix that Mikko presented before, when you can clearly identify your strategically material matters, which would be both material from an impact and a financial perspective, and then the ones that are kind of only material from an impact or a financial perspective. Just as a quick note here, when it comes to reporting under CSRD, you have to report on the matters already if they are either impact material or material from a financial point of view. But what we also stress often with our clients, of course, this is a precursor activity for CSRD. However, it also can be much more than that and can inform your strategic your ESG strategy, because you identified those topics that are relevant and material for your company with input from different stakeholder groups. So of course you have also the different group importances if you do that analysis. So it can be much more than just a tick box exercise for CSRD. Last but not least, we have step number 8 here, documentation of sign-off. Of course, part of it is to finalize the methodology together with the auditors in case anything changed in the last 3 steps, to have the final sign-off. One point that auditors often stress for our clients is that they want a very comprehensive documentation and clear rationale and sign-off for each of the steps conducted. So we provide that for our clients, collaborate with the auditors together, and then, of course, part of it here is also drafting the public communication and to deliver a final presentation to include any recommendations for future years and how to conduct the double materiality assessment in year 2, which is slightly different, and Kevin will talk about in a moment. I think with this, I hand over to you, Kevin. Thank you.
Perfect. Thank you so much, Victoria, and hello, everyone. Okay, so now shifting gears to one of the points that Victoria had mentioned in the previous slides. One of the key differentiators of CSRD is the requirement for sustainability information to be subject to third-party audit. And that includes specifically the process and results related to the double materiality assessment. Now, initially, that requirement is set at a limited level of assurance, but CSRD compliance will likely ultimately require a reasonable level of assurance after 2028, pending a feasibility assessment made by the EU Commission. The difference between limited and reasonable assurance is significant for those in the audience who aren't already familiar with these. Limited assurance is a baseline level of assurance, essentially saying that the auditor has found no material misstatements or errors. Whereas reasonable assurance is more proactive, it requires more analysis of internal controls, and it results in a positive statement that the reported information is materially correct, more akin to the auditing that's typically performed on companies' financial statements. Even the limited level of assurance, however, reflects a fairly significant ramp up in the scrutiny applied to controls and processes used to feed into CSRD disclosures. So for that reason, companies need time and the companies need to prepare adequately. Namely, we recommend that companies appoint an ESG auditor early on, well before the actual disclosure deadline, as early engagement with the auditor will help companies understand expectations and get validation on their double materiality process. We've also listed here several steps that are meant to help facilitate the audit. Namely, we highly recommend aligning your double materiality process with the draft EFRAG guidelines as much as possible, even though they are not authoritative or prescriptive. They are still very useful guidances, and we expect that auditors will look to them as well as part of the review process. For companies that are not used to collecting information on a wide array of ESG information, we recommend developing explicit processes and procedures for collecting and analyzing that data, including assigning roles and responsibilities within the company for doing so. And that will help facilitate year-over-year consistency as well. We also recommend prioritizing a quantitative approach to scoring wherever possible, following ideally the EFRAG scoring criteria that Victoria just presented on, and ensuring that there is widespread engagement with all relevant or potentially impacted stakeholder groups. And finally, and I cannot stress this enough, truly, I cannot stress this enough, we recommend ensuring maximal transparency in your approach, i.e. documenting and referencing all sources of data, inputs, assumptions, justifications, and scoring. Even in instances where judgment calls must be made or information is qualitative or subjective, you'll still need that justification because auditors will ultimately request it. Next, I'll talk about a few common pitfalls to the DMA process and some practical steps to successfully navigate them. So first, document and transparency. At the risk of repetition with the previous slide, again, it warrants highlighting a common issue that we have observed in our engagements with auditors in this process stems from a lack of documentation of inputs, roles and responsibilities, assumptions, etc. And again, this is why having the auditor validate the double materiality process and methodology early on will help ensure that the company is aligning, the reporting company is aligning with the expectations of the auditor. By contrast, a lack of documentation and transparency could endanger or complicate the auditor review, requiring extra time, extra resources to track back information, or even worse, rerun certain analyses. So the solution, of course, lies in consistent data collection processes and developing a culture and expectation of documentation. We also recommend having explicit and formalized CSRD leads internally who can compile and track the source of all key assumptions, inputs, and relevant information. And we also highly recommend considering what internal software tools you may have at your disposal to help assist in this data collection effort. Next, on the subject of hidden impacts. So this pitfall stems from missing potentially material issues by focusing either on limited areas of the business or not properly evaluating IROs stemming from the value chain. So this risk can be mitigated both through a mix of widespread stakeholder engagement, both internally with different functions and geographies, and externally with both suppliers, customers, and other impacted stakeholders. But also, you'll want to explicitly consider your company's impacts on your value chain when drafting that initial list of IROs. So it's not just on the engagement side, but it's also in the process of developing that long list and then subsequent short list of IROs. Then stakeholder engagement overload. For anyone in the audience who's already started this or has experience with materiality assessments, this may seem particularly familiar. The need for widespread engagement does not mean that all stakeholders should be engaged on all IROs. Besides resulting in survey fatigue, that completely disregards the need for prioritization, and it doesn't consider different stakeholders, different levels of expertise on various subject matters. For example, in practice, it could very well be bewildering for one of your contacts to be asked to provide input on areas that they have very limited knowledge about, or to respond to several dozen issues. So it's important to right-size your stakeholder engagement. Develop a strategy for which you ask specific stakeholders about specific subjects in order to collect credible information on the IROs that could impact those stakeholders. Next, on the subject of internal silos, another common pitfall is excluding key departments from decision-making. Again, CSRD requires companies to assess the materiality of a great number of topics. So internal communication between departments, collaboration across the business is essential to properly assess, identify potential impacts, risks, and opportunities, and assess their magnitude, as well as assessing the impacts, both quantitative and not quantitative, the impacts of material issues on the company's business strategy. Simply, CSRD touches on every part of the business, so every part of the business is going to want to be involved within this process. Then misaligned ESG and financial reporting. Another pitfall is the misalignment between these two types of reports, namely not incorporating the company's existing financial materiality or risk appetite thresholds when determining the materiality of ESG issues, and also reporting using applying different ESG time horizons than what the company typically uses for financial or strategic planning. The way to mitigate that is, again, to ensure the input alignment with several key internal functions, including finance, risk, audit, etc. Finally, important versus material. We see this come up quite often, especially in discussions with companies' leadership. Companies need to be able to distinguish between the importance and the materiality of an ESG issue. Just because something isn't material to the business does not mean that it's not generally important or that a company shouldn't act on it. It means it doesn't meet the threshold for what the company considers material to its business, which is a legal term that triggers mandatory disclosures. Companies that have been acting on ESG issues for many years, that have programs, policies in place, even if they don't rise to the level of materiality, they should not feel discouraged from continuing to act in these ESG issues. They can still be considered important and relevant for strategic and communication purposes, even if they're not material. Finally, looking towards the future, what can companies do to set themselves up for continued success? So we provided guidance here on several key steps, starting at the top of the wheel. We're essentially here talking about year 2 after a company is already disclosed against CSRD for the first time. So as you've likely noted from this presentation, the first year of reporting is going to be a heavy lift, including the time and resources required for a full CSRD compliant double materiality assessment. One of the questions that we often get is, do I have to do this every year? And the answer is no. There isn't an expectation that the list of companies' material IROs will change substantially year over year. So a lot of the work that's done this initial go around can be carried forward so long as it remains relevant. But that's the key phrasing, so long as it remains relevant. Companies will want to assess if there have been any significant changes in their organizational structure, their operational structure, or if there are any key new external factors that could generate new IROs or modify existing IROs. So classic examples could be major M&A activity, expanding the business into new geographies that have significant contextual risks, like a lack of adherence to human rights principles, or otherwise significant change in market conditions and new products and services that affect an entirely new set of stakeholders. Companies should, at the very least, do a high-level review of their list of material IROs from the previous year and assess what has changed and if the list needs to be adjusted. So it shouldn't be as resource intensive as in the first year. There does need to be a review and validation of that list against changes in the business and business strategy year over year. Then, as CSRD disclosures will be a matter of public record, they also represent a fantastic opportunity to benchmark your company's performance and disclosure against peers and industry leaders. So have your peers identified IROs that you wish to investigate further? Have they developed policies or action plans to mitigate negative impacts that could serve as inspiration? Are there areas in which your company is leading? This CSRD will represent a treasure trove of strategic analysis. Companies should also look to solidify their data collection processes year over year. Are there any areas in which the quality of data was weaker or required more assumptions and estimations? Were there potential blind spots? Are there areas that relied on small sample sizes? In particular, companies should look to improve on the financial quantification of ESG risks and opportunities over time. Now, as part of that data collection, companies should also integrate questions and considerations about the IROs within their regular stakeholder engagement. Use typical, standard, day-to-day, month-to-month stakeholder engagement as an opportunity to feed data into this process. Now, if the review of the business context results in identifying potentially new material IROs, then those new IROs need to be scored so that you can determine whether or not they will make the list of material IROs upon which you have to disclose. So again, hopefully the improved data collection and stakeholder engagement I just described can help facilitate that. Besides data collection, companies will be expected to improve their performance on IROs over time, meaning mitigating risks, maximizing opportunities. So companies should look to develop new internal policies or expand existing policies to explicitly cover strategy and expectations on material impacts. And then finally, for year 2 and beyond, companies need to keep in mind that they'll ultimately need to prepare for reasonable assurance, which means that this entire process is going to be much more heavily scrutinized following 2028. Now, everything I've just mentioned will support in that effort, but we also recommend monitoring evolving ESRS standards as they are published. Now, as we wrap up this presentation, I'd like to revisit a few quick summary takeaways for everyone in the audience. So first, double duty. Unlike traditional materiality assessments, companies will need to assess and score both the sustainability impact and financial implications of ESG issues in order to meet CSRD requirements. Second, there are some very useful guidance documents that have been published by EFRAG that we recommend reading, both to better understand the process and because it will help facilitate compliance with your auditor's requirements. Third, as CSRD is concerned with material impacts on a wide array of stakeholders, it's important to cast a wide net on stakeholder engagement within this process and basically make sure that nothing material is being omitted. And fourth and finally, CSRD requires that ESG information not only be audited, but also be increasingly financially quantified as well. This regulation is meant to serve as a bridge between ESG reporting and financial reporting, and so that therefore presents new challenges for the companies captured within its scope. So thank you for your time, everyone. We hope that this session has proven useful to you. We'll now take some time for a Q&A. So kicking things off, let's see. I have one question here. Okay, I see one question. What can companies do if they are unable to reach certain stakeholders, like regulatory bodies? Victoria, I'll lead on this one if that's okay.
Thank you, Kevin. I'm happy to take it. So, of course, some stakeholders are more difficult to reach, potentially regulators or maybe investors. So what you could do is take what we would call like proxy stakeholders. So, for example, when you think about investors, you can take the investor relations personnel that you have within your own company to understand the investor perspective, and the same also for regulators, so that you have an internal stakeholder being like a proxy stakeholder for an external stakeholder group.
Okay, fantastic. I see question, are you required to conduct materiality annually? So that hopefully was addressed in the previous slide. Not the entire process, but there does need to be a review of the material IRO list from the previous year and and validation that it is still relevant and still applicable to the business. Okay, another question here. Which internal members should form part of the group of governance sign-off for key decisions? So I'm happy to lead on this one. So again, CSRD is going to touch on a lot of different parts of the business. So there does need to be involvement of several functions. Off the top of my head, at the least, sustainability team. If there's board level governance over ESG or sustainability issues, they should at least have some level of oversight over this, considering the strategic implications. Risk, finance, HR, certainly the highest management body related, that governs ESG issues. But I suppose the key takeaway that I'd want to convey here is that CSRD is large enough in scope that it should not just sit within the purview of just the sustainability team. If a company has a sustainability team, it really should be a shared responsibility across different business functions of the company. Again, it's speaking to integrate some of these ESG issues across the company's entire business and planning. Okay, what other questions do we have? Is there any specific sustainability software that we recommend customers use for capturing ESG data in the single system of record? we've certainly seen a number of software providers. I don't think that there's any particular company that we'd recommend offhand, but there are several options in the market for software providers to help companies collect, collate, and track roles and responsibilities around ESG data collection and compilation. And of course, this is also a service that that consultancies can help with as well. Victoria, perhaps this could be one for you. What are some examples of non-ESRS matters that a company might consider as potentially material for CSRD reporting, but that doesn't neatly align with one of the ESRS standards?
Perfect. Thanks, Kevin. Maybe just to add one point on the previous question. So, of course, as you said, one service we provide is, of course, to evaluate also what potential platforms are the most applicable for our clients, because there are so many different solutions that it's not a one-size-fits-all. It depends on your industry. It depends on your sector. So there are a lot of different options. Depends also what kind of data they collate. Is it complete ESG data? Is it mostly focused on greenhouse gas inventory? So there are a lot of different options, depending also on the maturity of the data that the client already has in-house. So something we often do, of course, one of our key services is to do greenhouse gas accounting for clients. We also support clients then on a later, more mature stage to go from kind of Excel-based greenhouse gas accounting to a platform and be integrated into a platform. In the same, we can provide for ESG comprehensive platforms as well. Just to add on the previous question. But come back to your question now about the non-ESRS sustainability matters. So as I said previously, ESRS matters are mainly focused, or not mainly, but there's a large focus on social topics, social matters. So matters that are more seen on the governance side. So for example, tax strategy, internal tax policy, or things like ethical use of AI are definitely occurring and important topics that we see that are not specifically listed within the ESRS matters, which maybe you could argue it makes sense because there are other regulations for those. However, it's noticeable, and of course, it goes into this G part of ESG. So that would be an example.
And as a quick add-on to your points, Victoria, the 4 social topical standards within CSRD relate to your own workforce, workers in the value chain, affected communities, and customers and end users. And so there could very well be ESG topics that are material for your business that impact one or several of those stakeholder groups. And if so, then disclosures related to that topic would be applicable under those topical standards. I realize that we are now at time. So once again, I want to thank everyone for joining. I know that we didn't have time to get to everyone's questions, but please, by all means, reach out to us. We have our contact information here. Let's continue this conversation, and we hope to continue to be in touch with you. Thank you, everyone.
Thank you.
All right, take care.